Hey, what's going on, guys? This is Brandon, your trusted realtor, and I'm coming to you with another great episode. Today, I want to talk to you a little bit about the different types of buyers and the process of getting into the home and some of the requirements. This video is really motivated by my friend Kanisha Tillman. She's not only a high school classmate, I just graduated from high school a few years ago, but she reached out to me and we started kind of discussing, and she left a note under my post asking if I could make a video or provide some information about individuals who are self-employed. Now, a bit about Kanisha. Kanisha runs the TennisShoes.com website. Her website is dedicated to hair care for individuals, families that have blended families and are looking to have more information about hair care. She is a DIY queen and just an awesome individual to really know. So check out her website. Hopefully you've been looking at that while I peruse it, and I'll leave a link to the description below. But so shouts out to Kanisha, and this video is for all of the self-employed folks out there, so that way you have a little bit more insight into what the process looks like and what you can expect before you actually dive into it. Now, let's talk about the income requirements. Now, it depends on the type of company that you are. If you are an LLC or a corporation, that will make a difference. If you're an LLC or some type of or a sole owner of your business, you're definitely going to have to make sure that you have your business license and your articles of incorporation, and that stuff is squared away. You're also going to have to make sure that you have clear profit and loss statements, so everything needs to be documented. You need to also make sure that there's no commingling of your funds. That means that you are separating out your income that you receive from your business from your personal account. Those things have to stay separate. Remember that's also really just a good tip in general to make sure that you protect yourself, or making sure that you stay in the within the realm of the corporate veil. If you don't know what the corporate veil is, it's the protection that you receive from having a corporation or an entity. And once you begin to do things like commingle your money, you begin to puncture the corporate veil. That means that you become more accessible, and there's more reasons, if you're ever sued, for someone to say, hey, here's an indication or an example where this person did not separate or is not separating their business from their personal, and in fact their business really operates as a personal entity and not a business, and therefore it allows an individual in a legal scenario to access your personal finances, personal wealth, your home, etc. So you want to avoid piercing that corporate veil as much as possible. So making sure that your funds are separated from one another. Also, this means that taxes. A lot of self-employed individuals, and it should go without saying that one of the powers of being self-employed is that you get, from a tax standpoint, you get to write a lot of things off. You get to write off gas, you get to write off part of your household, you get to write off a lot of bills and lunches and etc. But with that, if you choose to write off everything and your business operates or functions at a deficit, and that's shown in your profit and loss statement because you want to avoid paying a large amount in taxes, that's going to hurt you. That's going to impact you because your lender's going to look at your tax statements, and your tax statements are going to be the determiner of how much money you have. In fact, what will happen is your lender will look at typically your last 2 years of taxes, and then they will take the amount that you made. So let's say you made $80,000 one year and you made $120,000 the next year. They will average that, and they say that their average stable or reliable income is $100,000. And so while you may see or feel that, oh yeah, I can afford a house that's a little bit more, they're going to say that your monthly income is $8,333 because that's your stable, reliable income at $100,000. So that is something to keep in mind, that when from tax purposes, 2 points. One is make sure that when you decide to purchase a home For many individuals who have a W-2, they can wake up tomorrow and make that decision and start the process of getting into the home. Literally, it can be in the same week. You can call me on a Monday if you have a W-2, and by Friday, you will have a list of properties and we can go out on the weekend and look at things for you. But when you are 1099 and you're self-employed, you have to begin to think in advance and how you have structured not only your business, but how you have structured your tax filings, aka your money. And if you are in the process where you have decided that you were one of those individuals that decided to write off a lot of expenses, you then need to work with your tax accountant and go back and readjust your taxes and your tax filings for the year. So that way that information is updated and reflective. Now you're going to have to pay some money potentially, especially if you earn more or you need to make adjustments. Or you may need to decide that in the year coming, for this future tax filing, which is coming up here very soon, that you are going to, dare I say, accurately report your earned income versus finding ways to write off those expenses. Also, make sure you keep a clear profit and loss statement. That means that you're going to have to manage each month what's going in and what's going out of your business. I know a lot of times individuals that are self-employed, they will rely on their bank statements because they use a card, but it's very important that you keep accounting of your expenses. Now, this can be frustrating from the standpoint of you don't want to do it every month or you don't have the time. However you do it, you need to make sure you have a system. Whether that's putting your receipts in a folder and accounting for them once every period. So that's typically the approach I take. Instead of stopping every time that I have a receipt and having to input them in, I may collect them for a period of time. I put them all in a folder, and then after a set period of time expires, I'll go in and enter that information for the corresponding period of time into an Excel sheet. And if you're fancy enough, just create a general Excel sheet like I've done, put in a column for the day, and you don't have to worry about filling in specific days and months. You can then take that information in a raw table format and then create a pivot table based on the month, and you already know what year you're in. You're welcome. Makes life that much easier. The next topic I want to cover with you is your credit score. Your credit score can be, for most lenders, right about 620. And that'll be where they want to start the conversation. I'll encourage you to always have a higher credit score, because having a higher credit score means that you're going to inevitably pay less for that home over the lifetime of that home, and you're going to pay less month over month because you're going to pay less on the money that you're borrowing. So I'm going to recommend that, because there's a direct relationship between your credit score and the interest rate, I highly recommend that you try to make sure that your credit score is in the department of 700, or at least in the area of 700, 680, 675, closer to that. So that way, even if you get one interest rate when at the point of underwriting, you're looking for a home, they're going to check your credit score again. If during that 30-day or 45-day process while we're looking for a home, your credit score has gone up, then that means that you are going to be eligible for a lower interest rate, and then your lender at that time will lock in your rate once we've decided on a property. So there's an advantage to starting being able to start looking at the 675 credit score range, and then we could be in probably 680, 690 by the time we get ready to close and put you in a better position for a better interest rate. Also, when it comes to your credit, that also impacts the amount of money that a lender is going to provide for you as well. When you are self-employed, a lender is going to be looking at potentially higher down payment amounts, anywhere between 5 and 20%. Now, that's not always going to be universally true, especially if you're not using a conventional loan and you're using an FHA loan. It's going to be important, though, that you make sure that you're able to substantiate your income and your monthly income earnings. One of the things about not piercing the corporate veil also means that if you are making payments to yourself, that that payment not only A, needs to be in a separate account, but B, you need to make sure that those payments or those checks that you're writing to yourself are actual checks that are made from the entity, the corporate entity, to yourself, and that money's being kept and managed in a separate account. Again, you need to go through this additional work so that way you have a distinction between yourself and your personal and your company. Also, another thing to consider is the debt to income ratio. This is going to be the kind of the third piece of the overall equation of what you need to do in order to prepare yourself. Your lender will look at your debt to income ratio of being about 33%. And that's going to be important because they're going to be looking at your DTI, not only 33% for yourself, but in total, not to include your business. A lot of times, and you need to ask the lender, but some lenders will include the debts that you have if you are a small business, and they will include those debts, those loans that you've taken out in order to sustain your business in or as part of your personal debt. And what will happen is that will increase your DTI. So if you've taken out a $10,000 or $20,000 loan, or even if you have if you've decided to ramp up your business marketing or production, and let's say you've taken out a $100,000 business loan, you may want to check with your lender to see if they're going to count that $100,000 business loan as a debt against your personal assets, and that in fact may impact you as a business owner or especially as a small business owner, which is kind of in that mid-cap range, in getting qualified for a mortgage. So I always like to tell you, talk to the professional or the individual that can give you the information as it relates to their company, and that's going to be with a mortgage lender. If you're looking to leverage down payment and closing cost assistance programs, it's no different than what I've said before, which is talking to lenders that are participating lenders in those programs, going to that respective website, whether it's the Maryland Mortgage Program or it's DC Open Doors, looking at that list of participating lenders, setting up a time to have a conversation with a lender that you select, or reaching out to me directly so I can connect you with lenders so that way you can have that conversation. They'll ask and they'll probably want you to go through the process of a pre-approval, but part of that process is really understanding your buying power and understanding where you are now. So hopefully this information has been helpful to you. My name is Brandon. I'm your trusted realtor. If you haven't done so already, make sure you like, subscribe, and hit that notification button. And I want you to stay tuned in and in tune to the latest and greatest realty here in the DMV and everywhere else. Take care, and I'll talk to you soon.